Okay, welcome back. We are on page 7 and we are looking at notes. Both interest-bearing and non-interest bearing. And whatever we say about notes, loans receivable will work. Okay, very similar to accounts receivable, except now we've got to deal with interest. Interest income must be properly recognized. So they either bear interest on the face amount, which is called interest-bearing, or have an interest element that's the difference between the amount lent and the maturity value. And that would be non-interest bearing. And you'll see what we talk about when we go through these. Even if a note does not bear an interest rate, one implied. Okay? Someone isn't going to lend money to another business and not give them any interest rate, right? We're trying to show something that makes sense. For example, if your parents lent you some money while you're going to school, there might be no interest rate, okay? But with businesses, there will definitely be one implied because you don't stay in business just giving people loans for free. Okay, so transactions will recognize interest. We will use present value, and that's why we need the calculator, to calculate what the note is worth today based on a given interest rate, payments, and period of time. Now, when you're calculating the interest, IFRS uses the effective interest amortization method, which I'll show you how to do. And ASPE either allows the effective interest amortization method or the straight line method, which is the same amount each bit. Effective interest amortization, you may have used it when you did bonds. You will definitely use it in 316 for doing bonds. And yeah, so that's probably the most important one to learn. Okay, let's go through 3 examples which show us all the different kinds of notes you could be asked to calculate. So, Bramble Corp, I just gotta go get my glasses. Bramble Corp. Thank you guys. Yeah, it's not really useful when your dogs are sitting at your feet and they're black labs. Well, they're not that big. They're kind of just small little labs. Well, they're medium. Okay, as you can see, my mind is wandering. So Bramble Corp was experiencing cash flow problems and couldn't pay its $118,800 account payable to Labucan Corp when it was due on September 30th, 2020. Labucan's year end is December 31st. Labucan agreed to substitute a 1-year note for the open account. These are the options that were presented to Bramble by Labucan. So, they can give them a 1-year note, give Labucan for $118,800 due September 30th, 2021. Interest at a rate of 8% would be payable at maturity. So, 2 things here. They've given us an interest rate. So they've given us an interest rate and no payments until maturity. Okay, so that's 1. Let's do that option, then we'll come back, talk about 2, and then do 3. Okay, assuming Bramble Corp chooses option 1, prepare the entries required on Labucan Corp's books, because they're the one that has the receivable, okay? So, and we want it September 30th, 2020, which is today, right? Yes, today, the year end for Labucan, and then next year. So, let's start September 30th, 2020. So, what happened? Well, did Labucan get money? No. Instead, they got a signed 1-year note from option 1. So we've got note receivable, and they cancel off their accounts receivable, and it's for $118,800. Okay, everybody good with that? Now, it's December 31st, 2020, and that is Labuchan's year end. So, it's the year end. That's where we do adjusting entries. Are they actually getting any interest payable now, or any principal for that matter? No. These general notes, unless they say there are payments made, don't get any payment until maturity. So there's no payment, but we've accrued interest. So we're going to have interest receivable and credit interest revenue. So we are going to accrue interest for how many months? Well, do we count September? No, because it's the end. So October, November, December. 3 months. So it's $118,800 is the principal. The interest rate is 0.08. And what do I multiply? 3 out of 12. Because this is in years, this has to be in years too. So it's 2376. Okay, that's great. So now, finally, it's September 30th, and that's the maturity note. Okay, so let's try and get some accounts out there first before we put the numbers in. Remember, this is Labuchan. They are getting, right, and we know it's going to be principal plus interest. So, what are they closing off? The notes received. And then we've got to deal with some interest. Okay? So, let's start with the cash. I'll just put the little calculation down here. How much cash? Well, $118,800. And what else? That's the principal. Just checking my math was right. So that's the principal plus the interest, which is 0.08 times 118,800. And that equals 128,304. So that's 128,304. And of course, you guys could take shortcuts. Take 118,800 times 1.08. You're going to get that, right? Whatever math shortcuts you want to take, you go right ahead. Okay, now let's see the notes receivable. How much are they canceling the notes receivable off? Have we done anything with notes receivable since the beginning? No. So it's 118,800, the original value. And in these types of notes, where the interest is added on, and it's not stated in the note, it'll always be like that. Okay. Now, is there anything up here we've got to close off? Yes, we have to close this off. Interest receivable for $23.76. Excellent, we're done, right? Does it balance? Nope. How many months of interest does this represent? This was 3 months last year of interest. Well, have we recorded any interest since January 1st, 2021? No. So we need to credit interest revenue for 9 months this year. So that's going to be 118,800 times 0.08 times 9/12, which is 7,128. What else could I have done? I could have just filled in the blank because I already calculated it in here. Okay? Nice and straightforward, nothing new since we did notes. This is the most basic note. So hopefully it makes sense. Okay, so that was option 1. Now I'm going to look at option 2. So option 2 is an installment note. That installment note means there's payments. And there are 4 equal payments of $38,292.50 made on the anniversary of the note. The implied rate of interest is 8%. So that's what we're doing on option 2. On page 9, assuming Bramble chooses option 2, prepare an installment note receivable schedule because there's payments coming in every year, and prepare the entries required on Labakan's books for, again, September, December, and then September again. Round to 0 decimal places. If you're doing it on, well, you are going to be doing it on Wiley Plus, just pay attention whether they want 2 decimal places or 0. Okay, so this is basically the setup. We've got the date, and notice there's 4 installment payments, so it's going to be for 4 years. We have a place for the cash payment, and then we're going to break this payment into interest and principal, and then the carrying value. So, they tell us what its present value is. Sorry guys, I'm just trying to see if they told us the present value, if we have to figure it out. Okay. Okay, so we know some things. I'm just going to do it down here. We know the payments are equal to 35868, just for simplicity. Okay? We know the interest rate is 8%. We know the number of years is 4 years. Present value, we don't know. So, I don't even have a thing here. Okay, so basically what we're trying to do is calculate the present. So I'm just going to go to the next video so I can grab my financial calculator. Okay, be right back.